Indian stock benchmarks reversed losses to turn green on Thursday after the economic survey. On Friday, investors will watch if the positive momentum continues as the rupee extended its record-breaking low run again. The survey showed India's economy remains on a strong footing even as the global environment turns increasingly uncertain. While the economic survey pegs India's potential growth at 7%, revising it higher from 6.5% for the current fiscal year ending in March. This is driven by sustained domestic demand, public investment, and structural reforms. Forward-looking indicators point to continued momentum across services and investment, while infrastructure expansion has eased logistics constraints and lifted efficiency. Inflation remains broadly contained, with core inflation subdued. That indicates that the improving supply-side conditions are on the rise even as food prices stay volatile. The survey showed the government is focused on controlling its finances, with the centre prioritizing capital expenditure and maintaining credibility, supporting macroeconomic stability into 2027. However, the survey delivers a clear warning on external risks. Global growth is fragile, geopolitics is reshaping trade, and policy uncertainty is near pandemic-era heights. The survey outlines 3 global scenarios for 2026, ranging from managed disorder to a low profitability but high-impact systemic shock. Despite strong fundamentals, the rupee remains undervalued, reflecting India's dependence on foreign capital flows to finance its trade deficit. While services, exports and remittances provide sustainability, they are not enough to offset weak manufacturing exports, making capital flow volatility a key vulnerability in a politically and geopolitically fragmented world. The survey's strategic message is clear. India must focus on resilience and not short-term fixes. Manufacturing competitiveness, export capacity and lower cost of capital are essential for long-term currency stability and growth. The survey calls for deeper deregulation, stronger state capacity and an entrepreneurial state that enables innovation, scales MSMEs and aligns public and private investment. With global shocks becoming structural, policy credibility, buffers and execution discipline are now strategic assets. India is better placed than most other economies, but not insulated. And for more on this, we're now being joined on the show by Dr. Suyash Bhatt. He is the Director at the Academy of Finance, Technology and Innovation. He's joining us live from Dubai. Welcome to the show, Mr. Bhatt. Thank you for making time for us today.
Good morning.
So, India's economic survey flags rising fiscal risks at state level. How serious is this concern, according to you?
So, there is it's a significant risk because if you talk from fiscal deficit perspective, I think it's accelerating in today's time, especially because of the trade tariff and other things that are going on. In fact, we have a total deficit of close to 250 to 300 billion dollars, especially from goods and not from services. So, which used to initially get offset by export of software and the remittances which were happening. But in today's time, I think in the challenging environment that we are in, we need this to be plugged in. And especially also in the capital markets, we see that 21 to 22 billion US dollars worth of net sale has happened of the FIIs in last 1 quarter. So which is also a bit of concern. So we need foreign flows. We also need foreign investments and to bridge this gap. And unless that happens, it would be a challenging time going forward. And structurally, I think government in this budget should be targeting making policy easy and also from ease of doing business, making rules simpler for the businesses to function.
Dr. Bhatt, is there a different calculation for fiscal deficit in this year's budget? And if so, what kind of an impact will that have?
Yes, in fact, not from a calculation perspective, but from the overall way the government looks at fiscal deficit, that perspective has changed. So for now, we have done very well because we had set a target last year of 4.9% of fiscal deficit. And we have touched 4.8. So we have basically better ourselves by 10 basis points. And for the next year, we have even a better target of 4.4%. But what the government is trying to do is target, instead of keeping this as a base target, they're looking at debt to GDP as a benchmark, which is something very new. And but it is also a very efficient way of looking at fiscal deficit. So their target is by FY 31, they want to bring debt to GDP to 50%. Currently, it is 56%. So when you are creating all the policies and actions around this, the approach has changed. So maybe from a mathematical formula, the formula hasn't changed, but the approach has changed, which is very significant, because if the government wants to reduce the debt to GDP, it would also put this pressure on states, because states then in turn contribute to this. So from an approach perspective, this is a very long term and a strategic shift, which the government has not had yet, because when you say that it is yearly fiscal deficit, you're just looking at yearly number, but not at it as a total impact on the economy. So that is something very important. And as an approach, I think this is a very strategic shift, and that would mean that a lot of things would change from a expenditure and policy perspective.
Right, and it is important to have that change in perspective and that being in tandem with the ambitious goal that we've set ahead. But the survey says that the rupee is undervalued despite strong fundamentals. What do you think is holding it back?
So, in fact, if we see the economic survey, and it mentions that, according to a market model of PPP, you would have a fair value of 85 to 86. But it also mentions that this is a tactical move. So, from a concept perspective, if we understand the if your rupee is stronger, then your exports are expensive. But if your rupee is weaker, your exports are attractive. So, in this time when there is a tariff war happening, and there is uncertainty, how do you make your products more attractive in an international market? So this is one very good approach, I would say, that the government has taken in terms of tactically bringing it down to 91. And yesterday, I believe it touched a record high of 92 as well. So this undervaluation basically works in our favor. And in fact, the report also says that by March, we should be touching 91.5 in terms of appreciation, and maybe by the end of the year, it could be 90.5. But this devaluation basically helps the exporters, and helps also the economy to bring that very dear dollar that is missing in terms of FII is not investing, or FDI flow slowing down. And globally, if you see, even Japan, whom we have overtaken and become the fourth largest economy, they have over years used this method of devaluating currency, and to make their export competitive. So not necessary that rupee falling is a bad thing. It basically, I would say, it is a tactical move, and I agree with the report that the economic report that has come, that it's more to adjust with this tariff war and the uncertainty that is there. And maybe over years it may appreciate again, but there's no harm at even at 92. You are basically making sure that you are more competitive in the export market, and especially these free trade agreement and other things that are coming in. The two big sectors which have got affected is leather and textile. So if we get this edge over our peers, which are the ASEAN countries, which have access to, say, European markets, where they already have a 0% tariff on them, and if our currency is little weaker, we have an edge over them in terms of pricing. So Indian textiles would be more in demand. Also, Indian leather goods would be more in demand. So in long
Absolutely.
run, I would say that this would help the Indian economy.
Right, and you've rightly pointed out that it's important to not have a myopic view at this point and look at the larger picture. And you also mentioned the uncertainties which have been plaguing the global geopolitical landscape. Now, the survey calls the global uncertainties structural. How should India rethink the economic strategy in such a world going ahead?
So the concept of structural changes, we are trying to say that it's not directly mentioning that, but the dollar hegemony is being challenged, and we can actually see this in terms of multilateral systems developing over a period of time, and where you have new blocs signing bilateral trade agreements. So over a period of time, in last 1 decade, you would see that the global trade in dollar terms has gone down uh, to almost 57% from 85%. So this also says that more and more people are finding alternative to dollar. And when we say structural, so that hegemony that maybe one country or few countries had is changing. And in the new system, you have BRICS as a block which has emerged. So if you see from a GDP perspective, close to 25% of
Right.
GDP is represented by the BRICS countries. So this is a very interesting new world order that is emerging, and hopefully in next 5 to 10 years, you may see that rupee may become an international currency in terms of a reserve, just like yuan has become over a period of time.
Absolutely, Dr. But we'll have to wait and see how these concerns are addressed. But for now, thank you so much for making time for us and sharing your valuable insights with our viewers.
Thank you.